Yeah.
See, episode 5, The Empire Strikes Back, number 11. Okay, Lord of the Rings. Where's this Goodfellas? 15. See.
Yeah.
See.
Number 15 of all time.
Yeah. Well,
This is a top 100 list, and this movie is in the top 25% of the top 100 list.
Well, maybe I've seen it more than once. So I just don't
somebody just liked the Twitter post. Or the Twitter post of the picture.
What are you talking?
My point is, Goodfellas is a multi-generational movie. It's the kind of movie that parents like say, "Hey, you got to watch this when the kid's old enough."
The advice provided on this podcast is general advice only. All statements made are considered by the participants to be accurate, but accuracy cannot be guaranteed. It has been prepared without taking into account your objectives, financial situation, or needs. All participants in this podcast may have a financial interest in any or all of the products or securities mentioned. Before acting on this advice, you should consider the appropriateness of the advice, having regard to your own objective, financial situations, and needs. If any private products are detailed on this website, you should obtain a product disclosure statement relating to the products and consider its contents before making any decisions. Where quoted, past performance is not indicative of future results.
Welcome to episode 29 of The Money Path with Bob Iacchino and Mike Arnold, founders of Path Trading Partners. Today's What and the Why segment is sponsored by MotiveWave. Go to pathtradingpartners.com and download your 14-day free trial. Let's join Bob and Mike with the casual conversations on the markets that's already in progress.
What's that?
Pokemon. Have you played it?
No.
Good.
No.
All right. So our one quick reference. This is sort of, I just called up a chart too. So Nintendo, I saw it scroll by this morning. Nintendo says financial impact from Pokemon Go will be limited. No plans at the moment to adjust their earnings forecast. Nintendo was the original creator of the Pokemon video games, as we've talked about, but and holds some licensing rights, but the main beneficiaries of the game are likely to be the developer, Niantic, and the tech giant Apple, which takes a cut of all in-app.
Oh, no.
So since we talked about the stock price last week, we were talking about it's pretty much started off at 18 before the launch. It now went up to a high this week of 38.25. So that's over 100% increase.
Wow.
And now it's back down to 28.7. It's dropping like a meteor coming back down.
Like a meteor coming back down.
Well, I guess a meteor coming back down.
So, hang on. Where is it now?
28.69, 28.70.
Yeah.
So I'd hate to be the guy who top ticked that one.
Yeah. What, the 38?
Oh, yes, I got it. 38.25. Oh. So that's our only reference there. We should also touch base. Last week we talked about the dollar index. We were looking for it to go up with a target of 98.30. Right now it's trading up to 97.15, so it's on its way to our target. So that's interesting. How about crude, Bob? What's going on with crude? You're sort of the crude guy.
Crude's falling like it should. I mean, the trade that we gave out on futures now a week or so ago was that if we got to close below 44.88, I believe it was, that I wanted to go short it, and I would put a stop above 47.10, and it did not reach 47.10. It did go down, get that close we needed. It went up as high as about 46. Let me get the exact level. The high since we decided to short it was 46.84. So with the stop at 47.10, there's no stop out, and we wanted to sell it at 45.50. So the close below 44.88 triggered a sell up above at 45.50, and we would put our stop at 47.10. We got that sell off. It's now trading around 44.02, so we've got about $1.48 in it right now in profit.
And what's the eventual target on that?
$41 or so. I think I had the target, and I don't have it in front of me, but I think I had the target of around 41.67 or so.
And that was all built out from charting and your understanding of how that particular industry,
Yeah, it was all built out of charting, and I always actually wrote a blog about it for Nadex today that I think we'll put up on our site once I remove the references to binaries and things because it's really a vanilla article. And it's part of my why is understanding some of the crude oil fundamentals. But we don't trade the fundamentals, as we've talked about time and time again. It's knowing that the fundamentals for some people are kind of a panacea. If they might be in a trade, the trade might be going against them. And if they understand the fundamentals, they can be a little more comfortable leaving their price target and their stop in place. But having said that, we don't trade the fundamentals. It's nice to kind of know what's going on behind the scene, but it's not necessary for successful trading at all.
Gotcha, yeah.
I just love these headlines that scroll by. WTI tumbles to 43 handle. 3-month lows as gasoline glut deepens. It's tumbling.
It's tumbling. I was actually, again, when writing that article this morning, I was kind of researching the headlines a little bit, just like you said, Mike. And the day after the EIA report, that's the Energy Information Administration, which is a governmental agency, they report on stockpiles of crude and gasoline. And again, I'll go into this in the why segment. But I was looking at headlines, and the headline immediately after the report said, massive crude oil draw, prices rally. And then since then, we're down. We were down almost 2.5% the very next day. So I'll go into that more into the why, but the headlines are always silly. That's one of the things. When we talk about understanding fundamentals, we're not talking about reading a headline and trading off of it. We're talking about actually understanding what's going on. Headlines can be misleading, right, Mike? Which is why price action is the only reliable thing.
Well, I love when you get the headlines and you're thinking it says one thing and it's so misleading because the article, there's nothing referencing the headline in the article at all. It's like somebody just generated a headline to get people to read the article. Then you're done reading the article and say, that's not what I got. Speaking of headlines.
Yes.
Yeah.
Oh, wait, we can't go there yet. We got to talk about, because you made another call. Futures, was it your NASDAQ option call, Bob?
Yeah, that was Futures Institute.
I get all these confused. Futures Now, you're like such a big star. I can't even keep track of you.
Futures Institute is the really flashy graphics of their bios, and it's very nice.
That is the Chicago Mercantile Exchange's educational arm. Futures Institute.
You have Futures Institute. Now you're like a co-host on Futures Now. Like you're not just a guest anymore. You're up there. You're Mr. You're leaving me in the dust.
I can't do it without you, Mike. You know that.
You're leaving.
When Futures Institute asked me to do some spots for them, they're focusing a lot on options in the very beginning, and I suspect they're going to keep doing that. So I will go to Mike. We'll talk about our opinion of the market based on the charts. Then Mike will come up with the option. So that's what when Mike says, let's talk about your option call. It's Mike's option call, but we talk about the direction. So we were both looking for a pullback on the NASDAQ. We got the pullback, and then Mike created this options trade, which was this bull call spread he just talked about. And it is positively screaming in our favor at this point since we were on futures.
Yeah, it's screaming. I mean, this is also the September option, so I was looking for this too. I mean, I was looking for this to reach target sometime probably towards the end of August, September, but it looks like this was really called because we've had the S&P break out to new highs, right? We've had the Dow break out to new highs, and the NASDAQ is playing catch up.
Yeah, and we do Futures Institute, which is the CME education arm, Chicago Mercantile Exchange Group education arm. And then we do a show called Futures Now, which is CNBC's online show. So we'll get a 3 to 7 minute interview on the broadcast side, and then we do about a 20-minute show online that's live and then obviously is posted as well. And so this was my first week sort of co-hosting that show as a trader with Scott Nations, the online show. So, and I'll be on Futures Now Monday at 11:30 Central, 12:30 Eastern.
You showed up on Yahoo.
Yeah, we showed up on Yahoo Finance as well. We did an interview. Look, we did an interview for Yahoo Finance specifically with a host named Shauna. I don't remember.
So here's a headline for earlier, although the stocks come back. Here's another misleading headline, and I'll tell. The headline was Fiat Chrysler shares slide on report of SEC securities fraud probe. Well, they slid for a bit. Now they're back up. But I saw this early. Civil lawsuit against Fiat Chrysler may provide clues about what prosecutors are looking at. Chicago area dealer, there it is. Chicago area dealer alleges the company inflated U.S. car sales by paying dealers to report selling more vehicles than they actually did.
Wow.
This is in dealerships in Illinois and Florida. So but I think there's a gangster connection because, if you're a gangster in Chicago or Illinois, where do you vacation? Where do you have your second home? You have it in Florida, Isn't that a tie-in? That's like we could go with Al Pacino.
No, it's deeper because Chrysler is owned by they're Fiat. No, they're Italian.
It is deeper. See, we got
Mike. You said there's a tie-in to Al Pacino.
Yeah,
he's an actor.
Yeah, but that's what I meant. It's like I was going with another movie reference.
No, you went with Capone. Al Pacino wasn't in Goodfellas.
No, I don't.
Went from history to fantasy in 1 second.
There's no stretch that you can go Al Pacino. You meant Al Capone.
Well, see, that's funny.
De Niro. You could probably go De Niro.
I could go De Niro. That's what my head's not working today.
Yeah, well, De Niro wasn't Goodfellas. Al Pacino wasn't Godfather.
Yeah, that's what I meant. I meant Godfather. I meant something.
I think you meant Al Capone if you said Al Pacino. That's fine.
You know what? My
not
stuff doesn't make sense. You want to know what else doesn't make sense?
What?
Stock earnings.
Okay, which stock earnings did not make sense?
They all don't make sense to me.
Yeah, because they're better?
No, they should have been. There were so many companies that lowered guidance.
Oh, for sure.
To an extreme. If they weren't beating them now, although there's some companies that lowered guidance and they're still missing their lowered guidance. They didn't lower it enough, though.
Do we have an earnings scorecard yet?
It's with the revised guide. The last one I saw was about 67% of the companies that have reported so far met or beat.
Yeah.
This historical norm, I think, is 70%. So we're close in the ballpark, and we're still we're fresh in the earnings season. So, but we're right in line with the norm. I think we should be higher than the norm with some of this lowered guidance. We had so many companies.
What's a scorecard? Is it like the Topps baseball cards I had with the gum? When you say an earnings scorecard, do you actually see a card, or do they PDF you something as an attachment?
No, there's several different companies that will put out, as Mike just said, how many have reported and how many of them have either beat or matched the market's estimate or their own estimate. All right, so here's what I'm reading from Thomson Reuters, dated July 15th. Okay. It says, of the 36 companies in the S&P 500 that have reported earnings to date for Q2 2016, 64% have reported earnings above analyst expectations. This is above the long-term average of 63% and below the average of the past 4 quarters of 70%. 50% of companies have reported Q1 2016 revenue above expectations. This is below the long-term average of 60% and above the average over the past 4 quarters of 48%. So that's an earnings scorecard. Now, one more line. For Q2 2016, there have been 85 negative earnings per share pre-announcements issued by S&P 500 corporations compared to 35 positive earnings per share pre-announcements. By dividing 85 by 38, one arrives at the NP ratio of 2.2 for the S&P 500. S&P 500 index. That's an earnings scorecard.
Gotcha.
Yeah.
So going into these numbers that we have, what is your outlook?
I don't know, Mike. I would say that means virtually nothing. So if you've got,
How was the bubble gum?
I was going to ask. So hold on. I was actually going to ask. Did anybody ever chew the bubble gum that came with the bubble? Remember how? Did anybody ever attempt to chew the bubble gum that came with baseball cards?
It was a challenge for me. I loved it.
This one guy collected the bubble gum and chewed the cards.
Yeah, that wasn't me. So, what I'm seeing with these earnings things, actually, I don't think they matter because things are going to do what they're going to do. And I harp on this because we have still tons of financial. What's interesting to me is the difference. We've talked about this before between GAAP and non-GAAP. and all the sort of, I call them the shenanigans, to get to hit or beat your number, even on these downgraded things. But these stocks are going to do what they're going to do anyways, because IBM is rallying pretty hard. I didn't think their numbers were that great. But, this is why I really look at stuff from a technical perspective, because they broke out of a horizontal channel and they're fulfilling with this is on a weekly basis. A couple weeks ago, they actually triggered a close above the horizontal channel. And since that time, that close was 154.34. This week, they released earnings. The target from that horizontal channel breakout is 164.77, or pretty much 165, and they're already up to 160.97. So this breakout preceded the earnings, and now that it's sort of like the earnings, it's now propelling it on the way to the channel, but it was already rose big last week.
So you're looking from the chart perspective. You got something that's looking good there. You're going to keep following IBM.
Well, if anybody's long IBM, there's the next target. If you're looking for a target, is about the 165 level, and then the next target beyond that is around the 172 level. Just some helpful advice for people if you're long IBM and looking to take some profits at some point.
What about Netflix?
Netflix.
Yeah.
Netflix. Well, that's all based off. A lot of these stocks have like one key metric that people follow, right, Bob?
Yep.
So for what is it for Netflix? Let's see. It's subscriber growth, isn't it?
Subscriber growth.
Well, why is that so important to Netflix?
Well, it's their only source of revenue, right? So if the subscriber growth slows, their revenue slows.
So they're not doing so hot. Here again, we're going to have the headline. Netflix plummets as growth story comes to a halt. Company says we are not growing as fast as we would like.
Yeah, that's hardly a halt.
So let's see. Their international streaming net adds was 1.52 million. They estimated 2.15, so that's sort of a big miss. Mm-hmm. Domestic net adds 0.3 million. They estimated 695,000, so they missed there again too. They see their third quarter earning per share at 5 cents instead of 7 cents, and so but they plummeted. Actually, what's funny, this has been a while back. When did this trigger? On a weekly basis. We haven't touched on this since essentially the first week of February. That's many, many podcasts ago. But Netflix actually triggered on a weekly basis a double top and then proceeded to rally. It triggered it when it closed at, 91.84. Then it proceeded to rally all the way up to, I think we talked about this, to 106.44. Is that right? No, 111.85, which is nowhere near the stop because the stop was actually above the 120 level. So a weekly pattern can take many, 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 many weeks to play out. Now it's back down to 85.80. So
is that a monthly pattern?
No, well, it didn't trigger the monthly pattern. It only triggered the weekly pattern. So it could now. It's still on a monthly basis did not invalidate the double top, but it's looking, if it stays down at this price levels, it could trigger it on a monthly pattern too, which then can take many, many, many months to play out. But this could eventually take, Netflix down to the 50 level or below. We're not saying that now, but if this pattern plays out the way historically it's with its targets and everything, it's not looking good from a pattern perspective with Netflix, and their numbers aren't looking so hot from earnings and a subscriber growth. So
Netflix is part of the quote unquote FANG stocks, right? Which has been something.
It would be the N in FANG.
Yeah, it would be the N, which is Facebook, Amazon, Netflix, and Alphabet. Alphabet being the G because Alphabet owns Google. So it's actually the FANA stocks, but no one's willing to change it to that. So the FANG stocks. So if you look at Netflix versus the other FANGs, okay, because these are the companies that people just kind of sometimes blindly buy You'll hear analyst after analyst talk about you got to own the FANGs, and they'll just buy all of them. Netflix is the most expensive by PEG ratio. Price to earnings divided by growth. All right. Actually, let me read an exact definition of the PEG ratio so that it's explained in the fashion that you might read it. So from Investopedia.com, the price to earnings to growth ratio, PEG, is a stock's price to earning ratio divided by the growth rate of its earnings for a specified period of time. The PEG ratio is used to determine a stock's value while taking the company's earnings growth into account, and is considered to provide a more complete picture than the PE ratio. So a good PEG, the proper PEG ratio is considered to be 1. If a company has a PEG ratio of 1, then their price to earnings matches their growth nicely. So it's not like, theoretically, the PEG ratio tells you that it's not fake PE. Okay, that's not like a multiple expansion or some version of manufactured PE. That's what it theoretically shows. So if you're over 1, you're considered to be overvalued. And if you're under 1, you're considered to be undervalued on the PEG ratio. Facebook is a 0.9. So the Facebook PEG ratio is almost perfect. Okay. Amazon's is 2.78. Google's is 1.3. Netflix, 9.2.
Ooh.
So based on PEG ratios, which I know a lot of money managers, like passive money managers, use PEG more than PE. The guys who don't actively trade a lot because they want to own a stock that is fundamentally sound and they want to hang on to it. They use PEG more than PE. And Netflix is a 9.2.
Wow.
So it is theoretically massively overvalued by the buy and hold crowd. Now, Microsoft. You wanted to chat about Microsoft a little bit.
I do.
Microsoft,
and my head's not in the cloud.
I know. Microsoft was one of the stocks in the Futures Institute now. I'm combining the names of the show. The Futures Institute now.
The future.
No, the Futures Institute video, which again is on our website at pathtradingpartners.com. I said that I thought Bank of America and Microsoft would beat. They both beat. Now, when there's a lot of companies beating, that's not too hard of a prediction. But Microsoft beat handily. They doubled the sales of their cloud product. So they reported 69 cents. The street was looking for 53 cents. Okay, and the 69 cents is above a year ago of 62 cents. I'm sorry, the expectations were 58 cents, not 53. So their cloud offering grew like crazy. Now, the cloud offering is something that Microsoft has been stating for 2-3 years, that this was going to be their move out of just being a PC company and becoming more of a service company, which is where they thought their future had to be with the dominance of Apple's product performance. And it seems to be working. I should look up Microsoft's PEG. That would be interesting, because their PEG should be coming into line now. It should be kind of where a desirable PEG ratio would be. So Microsoft's doing well. The stock is up over 5% since the earnings, and it's staying there.
Microsoft has really cleaned house and got their products right and combined their operating systems, and now we're seeing the fruit of it. Probably they're really able to have a small product like cloud be such a win for them.
Yeah, it's funny because they're when you look at what happened with Pokemon and Nintendo, their stock screamed and now it's falling. Microsoft stock, jumped up 5% and it's holding.
So their PEG ratio is 2.26.
Yeah, that's what I'm seeing too. I'm seeing 2.28. So.
Well, yours is wrong. Mine's right.
Okay, that's fine. 2.26 is cheaper, so I'm good. I'm good with that.
What's interesting now from a charting perspective, we've been in a horizontal channel really since last October, and we're now hitting the top of that horizontal channel with this strong rally based off earnings. If we can get a close up in this level, around the 57 level, the target for the breakout of that horizontal channel is 62.32 area. There's your target for any of you Microsoft traders or investors. That's the next target if we get this close. I'd really say above the 57 level. We're targeting the 62 level.
There is room to go.
So there is room to go.
Yahoo!
What?
I don't know.
Speaking of bad chocolate milk. That's Yoo-hoo.
That sounds right.
So speaking of bad chocolate milk, Yahoo, not Yoo-hoo. We triggered a double. We haven't touched on this one for a while, but we did mention it weeks ago. This is like the time machine show because we're talking about stuff we haven't talked about for weeks. It triggered back on the week of March 28th. This big double bottoming pattern, and then proceeded to go sideways until this week where it's breaking out. We had a target higher on Yahoo from that double bottom pattern up around the 45.50 level. Minimum target was about the 43.25 level. Max target was 45.58. We're now trading 39.12. But Yahoo has pretty much been sitting here. Although they did release earnings, how'd their earnings look?
Earnings were fine.
9 cents per share versus 10 cents expected.
9 versus 10 expected.
They beat on revenue.
1.3. Yeah, they beat on revenue. 1.31 billion versus 1.08 billion. So 5% gain year over year.
But you also have to look at now. Here's another teaching moment for people: the Q2 revenue ex-TAC.
Ex-TAC.
TAC. What is?
Yeah, TAC is traffic acquisition costs, and I must admit I don't really know how they reduce revenue. That's not something I'm familiar with because it's a traffic acquisition cost, right? So internet search companies pay that. So I don't that's one thing that's like I don't trade Yahoo personally, but that's one thing I never understood. Like, why is something that they pay make their revenues lower? I mean, if you're taking TAC out, the revenue should be higher. So it must be money that's paid to Yahoo, but it doesn't seem that way the way it's described.
They still have Alibaba, right?
They still own Alibaba shares, yeah.
So that's something that the number. What was the?
Like, do you understand that, Mike? I don't.
I understand nothing. I told you I'm a chart guy. So, but it's important because they always cite the numbers ex-TAC for these internet firms.
Yeah,
that have to acquire traffic. So, but here's the big news, and I think this is why it's starting to move. This has just rolled across the ticker this morning, and I'll use my headline voice. Verizon said to be close to buying Yahoo for $5 billion. Then the Verizon deal for Yahoo is said to exclude patents. Now, these are just rumors at this point, but it's starting to move. I'd actually love to see this deal finally get completed and it to hit this double bottom pattern that was triggered months ago, and then it gets to its full chart pattern outcome through this deal.
Yeah, I mean, we've talked about Yahoo, that Yahoo's it's only the only reason to buy it was to hold it for an acquisition. So we talked about the pattern when it triggered. But again, like part of what we just talked about a second ago, I don't understand ex-TAC, so I don't trade it. So I almost don't care. But it's definitely a story, and it's been out there, and it's going to remain out there. I don't know if this deal is going to close. It doesn't seem like there's any antitrust concerns with this kind of a deal because it's a communications company buying an internet search engine. It doesn't seem like there's antitrust there.
Comcast bought NBC. That was when Comcast bought NBC. That was just crazy.
See, I feel like the craziest one was when AOL bought
Time Warner.
That was nuts when everybody was like, "What? America Online bought Time Warner?" And so the interesting thing about it is AOL became a content company, right? Everybody, I remember when email first came out, I knew people. Okay, it was me saying, internet. Does that mean I got to get the AOL to go through the internet? I didn't understand. AOL was the internet for people like me who didn't understand it at all.
Speaking of buying things, Visa announced earnings. Did you? That was a good set. That was good.
It was pretty good, I guess.
You're not very enthusiastic.
Nah, it was fine. The best part of Visa's earnings is the buyback announcement.
Yeah, they announced a $5 billion stock buyback. Their earnings per share came in line. Well, it beat. They were 69, and they expected 66. Or the street expected 66. Revenue came in below, though.
All right, revenue fell. So, again, the best part of that is buybacks. The stock is up, obviously.
I don't think this stuff matters because I think most is people are still in a flight to buy stuff, and based off that yield conversation we have. So I think everything's just going up, especially things like AT&T. They just announced Q2 revenue $40.5 billion, expected $40.64 billion. So they missed on that. They came in line with earnings per share. They hit that number. It was down after hours. Now it's like we're in the buy the dip mentality. And AT&T is also a stock that provides. It's considered a safe stock that provides a dividend. So I think it's getting a little overdone, but okay, it's going. I would not be surprised though at some point a lot of these firms are. What's interesting to me with the financial engineering is it's exposed. It's covering up some weaknesses, and companies. I think their valuations are getting a little high, but that does not mean they're not tradable. This is a theme we touched on last week. There are a lot of trades that keep setting up, but there's not a lot of investments for me.
Yeah.
Because all right, I can see why people are rushing to AT&T with the dividend, and that's been having. It's look at where did it start? It started the year roughly 34, and now it's trading roughly 43.37. So not only does it pay a decent dividend, it's run up quite a bit, and although at some point. And it can go much, much higher. But at some point, I'm going to all these shenanigans and all these things are going to come home to roost, and we are going to see a correction. But the market could go much higher first before we see it. But all right, here's another one. Starbucks Q3 revenue $5.24 billion. They expected $5.33 billion, so they missed on revenue. I'm seeing a lot of companies miss on revenue. Earnings per share came in right in line, though, 49 versus 49. Their comparable sales plus 4%. They expected plus 5%. Now I wonder what the chart's doing. There we go. So it traded down after hours, but it's right back to where it started. It's just, if anything goes lower, people are buying it. Touch on the banks, Bob.
Well, they did well. And they killed it.
They crushed it.
Yeah, and that's really that's a massive positive for the market. I think one of the things that Mike and I have agreed on for a while now is that you have to kind of hate this rally because at its core, it's still an easy money rally globally. It's still a somewhat artificial central bank induced stock rally. But one of the things we're seeing, right, is that if I go back to the earnings scorecard, Mike says he's seeing a lot of companies miss on revenue, and we're below the long-term average according to the scorecard, right? But we're above most of the analysts' expectations. So it's kind of a mixed bag. Like I said, when I mentioned the scorecard before, I said I don't think this is really saying anything because on earnings, 64% reported above analysts' expectations, which is above the long-term average, but below the past 4 quarters. And on revenue, we're below the long-term average, but above the past 4 quarters, right? So it's just such a mixed bag. But the banks are different. The banks killed it. And if you remember the podcast last week, we talked about 15% of the S&P 500 was still below their 52-week highs. While we don't think, and again, Mike, if I'm speaking for you and you disagree, please jump in. But while we don't think this rally can end well, there's a lot of room for it to go.
Yes. Oh, I agree.
A lot of room for it to go. And if the banks lead it, that gives it more room to me.
So
banks did well. That's the first time in a while. That's why I like.
Yeah, it is. It is.
We don't need to like recite the numbers. They just did well, and it's the first time J.P. Morgan killed it. Bank of America killed it. Wells Fargo missed slightly, but Wells Fargo was the one that was doing okay through all of this stuff. They weren't doing terrible. So, banks killed it, and that is a big positive for the overall market.
Right, because healthy banks is a healthy market.
Mm-hmm. Could I buy Chipotle yet?
You could. I was actually going to touch on that. No, not long term. Chipotle dropped. Well, after they released their earnings, they were down 3%, but now they're way back up because again, it's buy everything. Second quarter comparable sales fell 23.6% versus estimated down at 20.6. That was a big headline. Here's why I don't pay, the numbers don't matter to me other than trying to spot macro trends and everything else. Chipotle, how long ago? Back on the 13th of July, triggered a daily pattern, horizontal channel breakout pattern, with a minimum target being 433.25, max target being 440.50. All right.
Mm-hmm.
Now we've just had earnings, and it's up to, on this rally, it reached a high of 433.42. So this earnings rally took it to its minimum high, and this could easily keep rallying to 440.50. So this was a tradable pattern. This would not be an investable pattern. We also have, on a weekly time frame, we have a lot of overhead resistance. Let me see exactly where that number is. Right around 439 to 440. So this could easily complete its horizontal channel pattern and still run a bit higher, but we're still trading against the weekly R zone or rotation zone. So, and it's going to be some pretty hefty overhead resistance. Why I'm saying this is a trade, not an investment. At some point, there'll be a time when I'd want to own Chipotle and sort of like tuck it away for a while. This is not that time. That does not say you can't make money trading this stock, but this would not be a stock that I'd put in my portfolio and just blindly walk away from for the next year or two.
Yeah, one of the things that's kind of hidden in their numbers is the comp store sales look bad, right? But the issue with the comp store sales is that it's actually improving. The decline in comps is improving, but the pace of improvement is very disappointing to analysts. Okay, so their comps declined 26% in April, 24 to 25% roughly in May, 23% in June. So what has to happen before you rise? You have to stop falling, right? So the pace of them not falling anymore is declining, but it's declining at a very gradual rate. You would have liked to see the comp stores fall 26% in April, then 20% in May, then maybe 15% in June. They're ticking off at about 1% a month right now, and that has to accelerate. There's so many mixed metaphors in there. The decline, the improvement in the decline has to increase. Basically, they have to stop their sales decline faster than they're currently stopping it.
I ate there the other week because they gave me a free guacamole and chips.
I tell you, I eat there once a week. I love it. I want to buy the stock because I know in my heart of hearts, I want to buy the stock, but I have to defer to the charts on one week.
Yes, and this is definitely a tradable short term. I could easily see this again running up to the 440 level, even possibly higher. But this is not something I need a bigger bottoming pattern on a weekly basis and have it stop reacting to its downward trending rotation zone before I'm interested in acquiring it. And that may happen as what you said, as the declines, get more. I don't even know what I'm.
It's a teaching moment for those of you on the path. How about that? Because I really want to buy the stock because I like the food, but it's not the right time to buy the stock. The price action isn't good.
Right. It was the right time to trade the stock based off this pattern, and I gave the targets for that, which is they're tradable things, they're investable things, and don't always listen to Bob's stomach is what I took away from this.
Hey, right. You remember a couple podcasts ago, a little bit off the subject, when I talked about why I can't stand when those guys talk about gold not being an investment because it doesn't make anything and it doesn't pay a dividend. Do you remember that conversation?
Was I on that podcast?
Yes, you were. It was. I actually got to say that to the guy when I was on CNBC Futures Now yesterday, but I made the mistake of saying it off the air, and then he agreed with me on the air before I got a chance to say it. So I did. I wrote it in my notes for CNBC that I'm not in that camp. And then prior to the airing of the show, this guy's name is Scott Nations. He's a good guy, but I told him, he said, I know your stance on gold, but I don't agree with you because you say gold doesn't make anything, but no commodity makes everything. Every commodity is an ingredient to something else. So if you're saying gold is not investable because it doesn't make anything, doesn't pay a dividend, then neither is crude oil, neither is corn, neither is silver, neither is soybeans, neither is soybean oil, neither is cattle. None of those are. Then you're a commodity trader. So if you're saying that the individual shouldn't invest in commodities, say that. And then he went on, and I feel I need to clarify this. He went on to say that one of the reasons he says that is because he can't stand the people that come on and pump gold because they're sellers of gold. They're gold brokers. And so they come on and say, you have to have gold as an investment. I'm buying gold because they're never selling it. So I want to throw that out there because I kind of have to give him credit for that stance because I agree with that. Okay, I'm done with that.
Well, why don't you touch on, since you brought up gold, why don't you touch on the gold trade?
Well, we want to buy gold on a dip. I mean, gold is, Mike mentioned the R zone, and gold's going into the R zone. Overall, in my opinion, like macro long term, gold is going to suffer because global demand for gold has been falling, especially in Asia. Malaysia specifically had a 40% decline in their demand for gold, which is the biggest since the third quarter 2012 for that particular region. Gold is an ingredient in jewelry. And if there's a decline in global riches, there's a decline in purchase of jewelry, there's a decline in demand for gold. The one place where gold demand increased was in the investment arena, meaning ETFs, and then actual physical storable coins. But those are doomsdayers. Those are like, the world is going crazy. So that was probably Brexit demand. That's probably what it was. And that's probably going to slow now. So longer term, I think gold is gonna fall. But right now, there's a decent gold trade where you buy around 1,300, 1,305. You get out of it below 1,270, and we're looking for somewhere around 1,401. So call it 1,400. And that's a trade. That's a trade that's on futures now. Which is also on our website. So
and
it's up there.
That gold and silver and other metals, goes into our electronics, right? So it's part of the
Well,
modern
silver
era.
does. I mean, there's not much industrial use for gold that I know of. At least it's not enough to where most of the analytics that I read even discusses it. But silver there is for sure.
Silver, yeah, that has a much higher usage in other stuff. Copper, I just want to tie this in real quick because I was looking at a copper chart earlier today. People should keep an eye on copper. If it can, it's back. It dipped. It retested the $2 level a few weeks ago. Now it's back at 223. If it can get a close above the 230 level, it has room to easily run to about 240, the 242 level. So anybody who's interested in copper, there's levels to watch for copper. Speaking of metals and gold, what's going on with the Fed?
Hey, real quick, back to gold.
Well, you can't keep going back.
Well, I wasn't done with it.
You were done.
Yeah, no. One more thing about gold is that they mentioned that in the interview that $100 for gold. They're like, oh my God, it's a huge move. And I started laughing because Mike pointed out to me last week that the average range over 14 days on a week or over 14 weeks for gold is $42. So you get theoretically
the average weekly range per week spread out the average taken over 14 weeks. So on any given week, if you're just going to do average, the number's what, 40? What were you saying?
42.
Okay, I just wanted to clarify that because it sounded like for 14. I didn't want people to misinterpret that over 14 weeks it would move $42.
No. Weekly. Yeah, you're right. And then the average daily range calculated over the past 14 days is $21. So you theoretically could move $100 in 5 days based on that. And remember, that's the average.
Right. So yeah, the $100.
Okay, hang on. Remember that clicking phone thing?
Yeah, I hear it.
I unplugged this phone.
That's his ticker tape. He has his own ticker tape.
Did you guys hear me? I unplugged this phone.
No, that's really your ticker tape machine. You're going old school on us.
Yeah, you have a monocle.
You're not getting it. I unplugged this phone. It just rang unplugged.
Does he actually have inside information of what the Fed's thinking, or is he just, and they actually sort of give him a purview, or is this what he's thinking and people think it's representation of the Fed? And I'm talking about John Hilsenrath. Did I say his name right? I can never say his name right.
Yep. Hilsenrath?
He writes for the Wall Street Journal. He wrote earlier this week that, quote, Fed officials gain confidence they can raise rates this year. Fed rate hike could come as early as September now that the financial markets have stabilized after the Brexit vote to leave the EU. Well, the current rate hike odds, September 20%, December 24%. Do you see them going in September?
I'm starting to lean yes, believe it or not.
Really? Right before the election?
Well, a couple of things. First of all, the election shouldn't matter at all.
No.
Whether it does or doesn't, I don't know. A Fed has never raised a rate going into an election, but they have raised rates in election years before, so they use that as sort of elections don't matter to us evidence. And I say, we've had several rate hikes during election years. It's not a big deal. But I don't think that there's not going to be, look, if the 1% to 2% economy didn't reflect on the president as it is, it's not going to reflect on the election. It's not like they're going to I don't think they're going to raise 25 basis points at this point, and the market's going to collapse 600 points, and it's going to force Trump into office. This particular election is just different. It's not like it's the vice president. It's not like it's Biden running and he's running on the great economy, right? I mean, if Vice President Biden were running and he was running on how they went from the depths of one of the worst recessions ever into 4% growth. So none of what I just said is true. Biden's not running. This wasn't the worst recession ever, and we're not in 4.5% growth. So this particular election, I don't think a Fed rate hike matters. I don't think it matters at all. So I don't think it certainly isn't something that I would take into consideration. So
what do you think the odds that they'll hike in September?
I think right now we're 50-50. When you look at, if they're concerned, everybody was like, you and I were in that camp, like, can't go before Brexit, cannot, too much uncertainty. And then after Brexit, Mike and I took a victory lap because we were like, look, this doesn't matter to the equity markets. No, actually, let me rephrase something. We didn't say they can't go before Brexit. We said they won't. All right, we didn't, because Mike and I were both saying this Brexit's not, first of all, I didn't think they would vote out. Once they voted out, Mike and I both said it's not going to matter, and it hasn't so far. If it matters, it may matter over the long term, but not in the short term. And I'm saying the same thing about the election now. With Brexit over, if they were looking at Brexit and they saw their reaction, they can actually sit there and go, look, Brexit didn't do anything to the market. We are not going to hit it so hard that we push someone else into office. There's just no fodder there for either candidate.
Morgan Stanley's disagreeing with you because they just published their latest outlook for rates in the U.S. Don't look for a rise in U.S. interest rates until 2018. The Federal Reserve won't be able to hike rates this year or next year because U.S. economic growth will be let down. We think globally it's going to really disappoint. They issued their outlook for GDP in the U.S. saying it would only expand 1.7% in 2017.
Yeah.
So they're not so positive on stuff.
Yeah, they suck. No, so okay. So look, the economy is not strong per se as we may be used to it. Okay, I mean, Mike and I have been around a long time, and this is not a strong recovery. But also, we are not at high rates. So I'm a little surprised at that from J.P. Morgan. That
was Morgan Stanley.
Or Morgan Stanley, I'm sorry. Who was I on? I can't remember this guy's name. But one of the guys I was on Futures Now with was saying that basically he brought up a couple of key data points. We're now up to 80% on positive economic surprises in the U.S., where our number's expected one way and it beats. We're at 80% now. The jobs numbers are stable. We're at 25 basis points on the target Fed funds rate. It's silly. Now, is it going to help the economy to raise rates? I don't think so. But are we at a point where another 25 basis point rate hike trumps, sorry, bad pun, actually overshadows the fact that earnings did a little better so far than the average, right? That revenue might be solidifying. I think if the Fed was only looking at Brexit, they were trying to convince the market they were willing to go, and they were only looking at Brexit as the only potential reason why they shouldn't go, which is honestly my belief. I think there's a chance they go.
Yeah,
I don't know.
well,
We'll see. It's a ways
let's
away.
see. We have weekly jobless claims came in at 253K. That was below the expected 265K. So that marked 72 consecutive weeks of claims below 300K, the longest streak since 1973. June existing home sales beat expectations at 5.57 million, the highest level in 9.5 years. And leading economic index showed a 0.3% increase after falling by 0.2% in May. So that is back up. So for the people's looking for reasons that they might have some better data and say we can hike, there are some things that they can cite. There are some numbers that they can cite. So,
Yeah, I mean, and they're citing them. I mean, I'm just not the Fed themselves, but you're starting to hear more and more about the potential for this kind of thing to happen. So I don't know. I mean, it's a ways away, and we all know that one number like the the August jobs number that comes out on the first Friday in September might change the Fed's mind and might change my mind. But I'm just thinking, I'm not saying they're going to do it. I'm sure as heck a lot closer to being
you're more
in the camp
leaning
than I
towards
was.
it than you were before.
Absolutely.
But remember, they are data dependent.
Yeah.
They cite that every time, meaning that they can change their mind in an instant depending on their next data point. So, but Mario Draghi was speaking, I think he spoke yesterday, and are they hinting, is the ECB hinting at more stimulus in September?
Yeah, I think so.
So we're going to get more money sloshing around, which I think can just it's got to go somewhere. That's one of the things I think that's driving our continued rallies in this country. So if they keep sloshing out more money, it's going to find a home. It's going to look for yield, and it's just more fuel here to keep a rally going. Do you disagree with that or agree? Or
no, I don't. I mean, I agree with it. I agree with it. I mean, it's just, this is the most unloved rally, but it's still not so broad based that it's out of steam, in my opinion. So I think it keeps going. I really do.
The euro's turned back down. It's roughly it's at 109. We got up to what we were trading up around the 112 level. We're back down to 109. If there's a lot of stock points, we're still in a horizontal channel. I would not be surprised longer term to see this retest the 106 level on the euro. What's the pound been doing, Bob?
I don't know. I'm actually looking at the dollar yen right now. I would assume, let me look at it, because I would assume that the pound hasn't moved much at all.
It's at 130.98, so it came off its lows. It rallied last week. This week it's turned down a bit, but it's still sitting.
Still sideways, right?
Yeah, it's
since Brexit.
But we got the downward sloping rotation zone against it, and so it could, unless it forms a nice bottoming pattern, it could push lower still. You said the yen?
Yeah, I was looking at the yen because I felt like the yen was a good proxy for what was going on, because dollar yen collapsed on Brexit and then went sideways and now starting to reverse. So if you take that dollar yen collapse as saying that the Fed needed to ease, that's how I take it, or at least need to come off their tightening schedule, right? Because people were selling dollars and buying yen. And now we're seeing it basically back. It's not only where it was during Brexit, it's above where it was during the Brexit vote. It was around 106. And now we're about 106.26. So dollar strengthening against the yen, and that to me is a proxy for the Fed right now, because that's the way dollar yen has behaved.
Yep, and the dollar is continuing that rally we spoke about at the beginning of the show and last week. So, it's moving up towards its target as we speak. And anything else you want to cover that's going on in Europe?
Yes, there is actually. So we've talked a lot about Brexit, and there's Banco Santander, right? You heard of them? They're one of South America's. I believe it's Brazil, but don't quote me on that. They're one of the more active banks in South America, is Santander. And they completely pushed aside any concern over Brexit by doubling their fintech fund, which is UK-based. So when there was all this talk about some financial companies needing to move their headquarters out of London, right? And, they needed to move it into Europe, and this was going to hurt the services economy. Okay, Santander is a Spanish bank, I'm sorry. So this was going to hurt the services economy in the UK, which is about 80-90% of their economy. By the way, UK GDP is like 85-90% services. It's not an exact number, but it's really that high. They have virtually no manufacturing. And the people are talking about the financial services being a huge part. Obviously, London is one of the 3 major financial centers in the world. It's New York, London, Tokyo. London was going to suffer dramatically, and this was going to crush the UK economy. Santander doubled the size of their fintech fund, which is called InnoVentures. It was a $100 million fund. Now it's a $200 million fund. Now, that's not a huge amount of money, but here's a major, major global bank, Banco Santander, and they said, yeah, we don't care. We're still in the UK. So if that's just a small anecdotal evidence of what may be going on there, Brexit really may be overblown. We'll see.
Today's edition of The What and the Why is brought to you by Motive Wave Software. Motive Wave Software is a well-established developer of easy-to-use, full-featured charting, analysis, and trading software built for the individual trader. Motive Wave offers the best charting tools used by the pros, such as Elliott Wave, Fibonacci, Gartley, Gann, and ratio analysis, but it's presented in a very easy-to-use way. Motive Wave has a product to fit any budget and any trading style, and one of the very best features, it's available on Windows and Mac. So go to pathtradingpartners.com right now to get your 14-day free trial, and then visit them at motivewave.com.
What?
So can I talk about my why of the week? I teased my why of the week when we talked about what crude oil was doing. And crude oil this week was interesting because every week the Energy Administration, I always screw that up, Energy Information Administration, the EIA, the government agency that releases data, a status report of the stockpiles of crude oil. Okay, so how much crude is basically in storage at Cushing, Oklahoma. All right. That report is released on Wednesday, 9:30 Central time every week, 10:30 Eastern. And the 2 numbers that people pay the most attention to are the crude oil draw and the gasoline draw, or subsequently the crude oil build or gasoline build. Did the stockpiles increase or decrease? And they're obviously looking for insights into the supply and demand dynamics of crude oil. So this week, crude was trading at around 45.45 when the information came out, and the EIA reported a 2.3 million barrel draw of crude oil. Okay, and price rallied from there. All right, price ended up on the day. Price was down on the day. It was down close to 1.5% when the number came out, and crude oil ended up positive on the day. But what was also reported was a 900,000 barrel build of gasoline. So the dynamics of a barrel of crude, 51%, a little bit more than 51%, but let's say 51% of a barrel of crude oil is refined into gasoline. Same gasoline you put in your car. Mm-hmm. And that 51% of that barrel produces 19 gallons of gasoline. Okay, so that equates to approximately 2.21 and a lot of decimal point places barrels of oil to make a barrel of gasoline.
Right.
So remember, in the EIA report, they report everything in barrels. So there was 900,000 barrels of gasoline. It was actually 911,000, but I'm going to use 900,000 for the sake of this example. So the next day, crude oil futures prices fell 2.5%, back to where they were and even lower. Well, why? If there was a 2.3 million barrel draw on crude oil stocks, right? Price should be higher. Less supply of crude oil, higher prices. But people started to notice, which people who've been in the oil business know right away, is that the build in gasoline is much more problematic than the draw on crude. Because if you have a build of 900,000 barrels of gasoline, essentially that's 1.989 million barrels of crude. Right, it's about 2 million barrels of crude. 2.21 barrels of crude to make a barrel of gasoline times 900,000 barrels build of gasoline makes close to 2 million barrels of crude oil needed to have made that gasoline. So if the refineries pull 2.3 million barrels out and they're looking at a 2 million barrel supply of gasoline, they're not going to be pulling more crude out in the near term unless that gasoline supply reduces. So that's why prices are falling again. That's the why behind what. So the dynamics of a barrel of crude actually matters. When you're seeing the EIA report, you need to look at not only what happened to the supply of crude, but what happened to the supply of gasoline. If they both drew, prices are likely to go up. If they both grew or built, prices are likely to fall. But when there's a mix of a draw and a build, regardless of which one drew and which one build, you have to do that math. And you have to kind of project out. This is why Mike and I trade price action. Because how fast could we do that math, right? Probably fairly quickly. The key is 2.21, right? 2.21 barrels of oil to make a barrel of gasoline. So you can do that math pretty quickly. But when you're sitting there wondering, why is this back down? They drew 2.3 million barrels of crude. That's why, because the report was essentially a wash.
You know what I just felt like after your little why segment?
What?
I felt like I just took a algebra test with those really long word equation things, like when did one train's going this direction, one train's going this direction, and they're going to pass at some point, how many, and I feel exhausted now.
Well, here's the funny part. My why could have simply been, it takes 2.21 barrels of crude to make a barrel of gasoline. Saudi Arabia talks about them having so much more capacity to drill, but a lot of what they will drill out is useless crude. It's this thick sludge that you can't really make into gasoline. That's why they don't drill it, but they continue to threaten that they're going to. But it's kind of useless oil.
So this is why I trade price action, because I'm asleep now. Literally. And I just came up with a new what, since I was so over anxious because that damn hyena was chasing me. So, and I wasn't breathing and I passed out. And then when I woke up, I said my what earlier in the show, which was NASDAQ retest the highs. So I came up with something else that's related to the show. This could be very useful for people. We talked about the FANG stocks when we talk about Netflix. So we have Facebook, Apple, Google / Alphabet, and so Facebook came down about 3 weeks ago to the lower part of our weekly rotation zone, closed up, and we expected it then to retest the highs. It has retesting the highs. It's actually making a new high as we speak. I think we're still going higher. We should proceed up. My next target for highs on Facebook, 124.25, and then beyond that, 128.50. So as Facebook continues to rally, those are my next two targets I'm looking for. And since that's the only FANG stock that is making new highs, I think that's important. I would not be touching Netflix with a 10-foot pole because it's going to trigger more shorts. Apple's just sitting there. I think we're all waiting for Apple's earnings to see what's going to happen there. Google is or Alphabet, but GOOG is trading 741 right now. Its prior highs were 789. It has made a very nice horizontal channel. So if it approaches its upper level of its channel, we will talk about that in the future with giving price projections for there, but it is not close yet to making new highs. So the only one who is Facebook, and those are the levels I'm watching.
And also has the best PEG ratio.
Yes.
Cool.
And now I am exhausted.
Hey, I wanted to point something out, guys. Next week, we're going to do an ag segment, and we're going to have Alexandra Lively on the show. She was a Chicago News Bureau chief in the ag area at the Chicago Board of Trade, so she knows quite a bit about grain commodities. We've got a little bit of a heat wave here in the Midwest. There's some rain, but there's some heat, and I think it's interesting to talk about, especially when you look at the importance of agriculturals in things like ethanol and crude oil prices and things like that. So we're going to have a little segment on ags and some of the other commodities. And she's a lot of fun. So I think that'll be a great addition to the show as a guest host or a guest. What do you call them?
Are you replacing me?
No, she's just a guest.
You're replacing me?
She'd be a guest. I was going to say guest host, but she's not a guest host. She's a guest. This is Bob Iacino saying goodbye.